Hey, welcome back to my video, guys. Today, I'm going to be talking about why Dave Ramsey gets it wrong when it comes to investing in real estate. And before we get started, I just want to say I agree with Dave Ramsey's philosophy on budgeting, getting out of debt, and managing money on almost every single thing. The only part that I don't really agree with him on is his philosophy on investing, which is only paying cash for real estate investments. See, I think his advice overall is great for the average person, but if you're looking to grow your real estate portfolio and you don't have a ton of money in the bank, as I didn't, then I think there is a much better way, which is leveraging other people's money and taking advantage of the low interest rates out there. I don't know about you, but I didn't have a ton of cash laying around where I could just pay cash for real estate. But if you do, then that's great. That is one way of investing, and he's clearly been successful at it. So that's who this video is mainly going to be for. Someone that's looking to grow their real estate portfolio and they don't have millions of dollars in the bank. One thing he doesn't talk a lot about is how he lost his real estate. See, when Dave Ramsey was younger, he had millions of dollars in real estate and they all had debt on those. And he always talks about it on his show, how he lost everything because of debt. The main difference between when he lost everything versus what I'm going to be talking about in this video is he was taking advantage of short-term mortgages, which were basically private mortgages that could be called at any time. And at the time that he lost everything, the market was shifting and the mortgages got called all at once and he had more debt than equity. So that's why he went bankrupt. So I don't blame him for only wanting to pay cash for everything and not having debt. I'm not saying debt is the best thing in the world, but if you know how to use it properly, then you can make a lot of money and be very successful in real estate. So let's get started with the video. So what I'm going to be talking about, I'm only going to be talking about leveraging 30-year mortgages. I'm definitely not going to recommend hard money loans because those are where you can get into a lot of trouble if you don't know what you're doing. See, when I was 23, I was only able to buy multifamily property because I borrowed money. I didn't have $500,000 laying around in a bank that I could pay cash for it. So leveraging the money that I did have, I was able to get into real estate investing at a much younger age and much earlier on, to where now the property that I invested in about 5 years ago has more than doubled in value. So if I had just waited on this, I would have lost out of $500,000 in profits. Not to mention all of the tax benefits that owning real estate has. So let's say you follow Dave's advice and while you're saving up to pay cash for a rental property, you put your money in a CD or a bond. You're going to be losing out on a lot of appreciation, a lot of tax benefits, and just overall a lot of experience that you could be gaining as a real estate investor. So let's say you follow his advice and you have $100,000 you want to spend on a real estate investment. So let's say you find a $100,000 house to invest in and pay fully in cash. So then let's say the property rents for $800 per month and you have $100 per month in expenses. That means you'll be cash flowing about $700 per month on that fully paid property. That comes out to $8,400 per year. Now let's also assume that the property appreciates at 6%. That means in 1 year of owning the property, it would appreciate by about $6,000. So in total, you'll have made about $14,000 in the first year. Now let's say you leverage your money and use mortgages to buy real estate investment. Let's say you take that same $100,000 in cash that you had, but spread it out along 4 $100,000 properties and put 25% down on each. That means with your $100,000 investment, you'll have $400,000 worth in real estate. Now let's say those 4 houses each cash flow $700 per month as well. But now you have a mortgage on each of the properties. So that's going to be about $300 per house. So that leaves your cash flow down at $400 per house. In total, that's still $1,600 per month that you're cash flowing between the 4 properties. Now, when you look at appreciation, you have $400,000 worth of property that are appreciating at 6%. So instead of $6,000 per year in appreciation, you're going to be getting at least $24,000 per year. This is all just adding to your net worth each year from doing nothing. The other thing you have now, since you have mortgages, you also have principal pay down. This is about $6,000 per year on the 4 properties. So that's increasing your net worth by another $6,000 per year. So that means you're increasing your net worth by $30,000 per year and you're making $20,000 per year in pure cash flow. And that means you can put that money back into investing in more real estate. This is where you see the real snowball effect when you're investing like this. Versus if you're trying to pay cash for properties, it's gonna take you a decade probably per property. Eventually, you'll have a lot of cash flow, but it's gonna take a long time and you'll miss out on a lot of opportunity. So the mortgage interest that your tenants are paying for, you're able to deduct and pay less in taxes on the profits you're making from your properties. So I'm not suggesting that you get as much debt as possible. In fact, quite the contrary. Every year that you own these properties, the amount of debt on the property is going to decrease. So you're going to have less risk involved in each of the properties. If anything were to happen with the market, then you'd have plenty of equity in the properties where you wouldn't be facing bankruptcy. So if you know what you're doing and you do it right, there's a lot of benefits and there's very little risk to investing in this method. And while it may not be for everyone, this is the path that I have chosen to get started. Like I said earlier, I didn't have a ton of money to invest, and it was the only way that I could get my foot in the door. And I know a lot of other real estate investors that have done this to get started as well. So if you like this video, please leverage the like button down below, like the video, leave a comment, and subscribe for more. Thank you, and see you next time.